A very good afternoon to those in India and the East. Good morning to Europe and to those waking up in the United States. My name is Rudra Chaudhuri. I'm the director of Carnegie India. It gives me great pleasure in welcoming you to the fourth in a series of webinars on and around COVID-19. We at Carnegie India are committed to bring to you top-line analysis based on deep and collaborative research, especially in this time of a complex health emergency. The pandemic has deepened the fault lines across issues around globalization, international cooperation, the future of work, the import of technology, the balance between privacy and contact tracing, the role of the international, and the rise of the national. These are only some of the areas of interest that our scholars and research teams investigate and explore. Our work on COVID-19 is organized in a dedicated webpage, accessible through our website, carnegieindia.org. Today's webinar is titled Coronavirus and the Future of Global Finance. For many governments around the world, the playbook for a financial emergency such as this is shaped by what they did or did not learn during and after the 2008 crisis, more than a decade ago. That cognitive template, in part, is informed by those trying years. In the case of India, and as officials and diplomats make clear, the strategy at this time is directly linked to actions taken in the 1990s and then again after 2008. Yet, we live in a time of near negative oil prices. According to The Economist, in real terms, the price of oil today is the same as it was in the 1860s. The concentration of manufacturing for exports in China has more than doubled between 2002, when the SARS epidemic broke out, and 2019. This, in turn, and over a period of 2 decades, recreated global supply chains. To an extent, the intense competition between the United States and China pushed boardrooms and risk analysts to begin to hedge their bets, much of which appears to have been accentuated at present. How then is the world, and more specifically Asia, doing in dealing with the crisis? What will be the implications of growing debt and currency expansions? How effective have both international financial institutions and central banks been in their fiscal and monetary responses? In the case of India, what will happen to the large services industry that has driven growth in the last many years? Would this crisis witness the reversal of urbanization in different parts of Asia, shifting economic activity to rural geographies and forcing perhaps the reimagination of a more inclusive globalization? To examine these questions and fault lines, and to give us a clearer picture of what really are the challenges in the present and the extent to which the experiments with fiscal and monetary policies will pay off, we're joined by a very special set of speakers, Trinh Nguyen, Adarsh Sinha, and Pranjul Bhandari. Trinh is a non-resident scholar in the Asia program at the Carnegie Endowment for International Peace in Washington, D.C. She's a senior economist covering emerging Asia at Natixis, based in Hong Kong. She previously worked at HSBC as an ASEAN economist from 2011 to 2015. Trinh has been awarded the Best Economist on Vietnam by Asia Money. Prior to HSBC, Trinh was a consultant at the World Bank, where she focused on FDI and trends in the labor markets in different parts of the world. She holds an MA in International Affairs and International Economics with a specialization on Southeast Asia from Johns Hopkins University. She's a regular contributor to the FT, and we're absolutely delighted that she chose to join and contribute to the Carnegie Endowment. Adarsh is a managing director, co-head of Asia Rates and Currencies Strategy at the Bank of America Merrill Lynch. Based in Hong Kong since 2010, he's responsible for the Asia Rates and FX research efforts in the region, covering both developed and emerging markets. Adarsh was part of a team that ranked number 1 in the currency and rate strategy category of the 2014 and 2017 institutional investor surveys. He was an FX strategist at Barclays Capital in London, where he was responsible for the forecast and fundamental analysis of G10 currencies. He received his master's in economics and management from Brasenose and Oxford. He also holds an MSc in economics and finance from the University of Warwick. Pranjul Bhandari is the chief India economist at HSBC Securities and Capital Markets. She's responsible for developing the firm's position on macroeconomics and public policy in India, leading the firm's economics research franchise from Mumbai. Prior to joining HSBC, Pranjul completed a resident fellowship at the IMF in Washington after graduating as a Mason Fellow from the Kennedy School at Harvard. She's worked at the Indian Ministry of Finance with a chief economic advisor and at the Planning Commission with a deputy chairman. She has held roles as an economist covering Asian markets at Goldman Sachs and at DFID. Pranjul also holds a master's in economics from the University of Cambridge and has been popularly featured as an economist who is not afraid of taking contrarian calls in times of crises. Before I turn to our guests, a couple of housekeeping points. There are over 250 people who join us for this webinar, some on Zoom, many on YouTube Live. For those of you on Zoom, could I please ask you to function your questions in the icon at the bottom part of your screen. The questions will be clustered and I will relay them directly to the panelists. For those on YouTube Live, could I please ask you to add your questions in the comments box and they will be sent to me and I will push them on to the panelists. With that, could I please turn to Trinh for her opening remarks and to perhaps help us frame the debate for the discussion today.
Hi, good morning and good afternoon for those joining from Europe. Good morning. I would just frame the questions in three ways. One, we'll just talk about first what's happened in terms of macroeconomics and mobility in Asia. The second part is what has government done in response to that through monetary and fiscal policy. And thirdly, we'll discuss what that means in terms of growth. And beyond this, when we think about beyond COVID-19, or can we actually think about the COVID-19, the investment trade trends that we expect to see in the region. And with that, we think about the triple Ds, and I'll explain soon what that means. So first, it's very easy. You just look at any data and it's terrible. In Asia, we are under lockdown. In India, as you know, it's all the way till the May 4th, but India is not alone. Across Asia, in Singapore, Vietnam just finished it, but mobility is not great. So if you look at Google mobility, which published up to the 17th of April, the worst is the Philippines. But India is just right behind, a minus 60-something% from mid-Feb base level. The best is Taiwan and South Korea because it has containment policy and so it doesn't have to lock down. What does that mean? When you have a restriction of mobility, which means that sectors like retail, recreation, anything that it makes people go out is going to be impacted. Most importantly, economies are very dependent on services, and we know that service income is irrecoverable. What you don't eat by sitting at home, not going to the restaurants, the trips you don't take, you're not going to take them twice as much when you come out of lockdown. And moreover, you have to think about the not just the loss of income and what that means in terms of confidence and the multiplier impact in terms of employment and debt and etc. And in places that have already gone through lockdowns, such as China, for example, that went through it in February, and the normalization has been very painful in March. As you can see, that it's easier to renormalize on the supply side, but the demand side is more difficult. And what that means is then we have employment issues, and we have not only that, the lockdowns in developed markets coming back to bite very externally exposed economies in the second wave of demand. So we think that in response to this, you know what has happened in terms of monetary policy. Rate cuts in Asia are nowhere as big as the Fed. And that is due to several reasons, partly because of the dependence on external funding for a few countries, the hit on FX, which other panelists will discuss more, and that limits the space for them to move. And so even on the fiscal side, it's been very limited. We did a study on across Asia who's done more, and if you look below the headline number, the largest that we've seen, of course, is the headline number you see for Japan, but you dig below that, the reality is very much less than that, because much of that is discretionary versus actually on budget spending. And so on the spectrum of what's needed to offset versus the graph of you see the decline of mobility is not enough. So in other words, we agree with the IMF. The IMF thinks that on average, Asia will contract by 1.9% when they write this report. The Great Lockdown, we think that it's going minus 2.2. We think that it's going to be around minus 1.9, 1.2%. And for some economies, that's going to be much worse. We think the Philippines, Thailand, for example. India, I completely disagree with the IMF. I think it will go into contraction given the length of the lockdown, given the importance of the service sector, and also the effect afterwards. Beyond these short terms and growth and basically the conclusion we want to make is that more will need to be done, particularly in economies where we think that it will fall rather sharply. And there's some sectors where you know for certain will be gone, such as tourism and transport. And the way we normalize that is going to be very difficult. How do you normalize transport when the cost of ensuring the infection is going to be quite expensive to fly, for example? And even in Hong Kong, which is heralded as one of the best places handling this, their normalization is going from 3% of capacity to 5% in June. And that in itself speaks volume, that this is supposedly the gateway to the world and China. Beyond this very terrible news, what that means is that next year you're going to have a very easier base to recover, but don't get too excited, because if you take the average of the two, it's going to be substantially below trend. It's just because the base is very weak. Beyond this, we have to look at the trends that are happening. There are three things happening that we think that are key risks and can be opportunities for India. Risk number one is deglobalization. We have done many studies on the global value chain. We know the global value chain peaked around 2008. And what has happened, actually, the trend has been some regionalization and sub-regionalization. In Asia, there has been a move away from China by Northeast Asia, which has been very dependent on China in terms of externally linked, moving to Southeast Asia and the rest of the world, such as Europe, China, and increasingly India. Now, on top of that, what that means is that this virus, which exposed our exposure to the vertical integration of China, will further accelerate that process. The question is, where can you go and where will receive this? And so far, really, Vietnam stands out for its cheap wage, etc. But Vietnam is a very small size economy. There's only so much absorptive capacity to do so. And India is clearly the place where it should position. Already, if you look at firms looking to sell consumer goods such as electronics, etc., India is the place. But it should position itself, in our opinion, not just as a consumption and the story beyond China as the only economy that is so large in size, but also a place to absorb labor. A paper we did before Modi during the election was really about labor issues in India. Something that people don't discuss much is really the fact that India hasn't published employment surveys since 2012. What that means is we don't really know how good or bad the labor situation is. The ILO numbers for India are all just estimates. But basically, if you look at the ILO estimate, it tells you that there's too much informal. So you still have a lot of labor to be absorbed. And the way for India to move forward is really this capturing this global trend, and I think it's well positioned to do so. The other two ones is, as I'm taking too much time already and I'm going to stop, there's no time to discuss that, is really about debt and demographics. But I'll end here because I see that I'm out of time.
That's fine, Trin. Do you want to just complete your comments on debt, and then we can perhaps move on?
Okay, yeah, sure. Okay, so I think we know. So debt is, we have an income shock at the moment, and that's something the Fed and major central banks try to offset through the supply of money and some of the operational issues. But the debt issue is really salient for many. Well, China is an example where it has 3 times leverage ratio. Really, it's a corporate debt issue, and increasingly households. So households about roughly 50% of GDP. Some other ones like Australia, South Korea, Malaysia, Thailand, household debt issue is an issue, which means that central banks can try to help with this. As you know, the RBA has tried to lower rates and etc. But ultimately, what that means is going to be a huge drag for consumption moving forward, because we have this income shock and the debt stock is still remaining the same. And all of this is going to put downward pressure on growth. The second idea is demographic, which we all know, and that is something that is easier to forecast. UN population statistics do this. And on one hand, you have East Asia, and even in Southeast Asia, you have Thailand and Singapore aging. And so in our opinion, the future is that you are going to have a situation where domestic demand is king. And demographics can be destiny, but there's still plenty of competition for such. So for a place like India to compete, and I think it's unrivaled in terms of its demographics and competition for FDI. And if you look at valuations, for example, the equity market, India has consistently been the most expensive in Asia, even after this massive sell-off that we've had this year. And that's partly because investors have really are very fundamentally want to be bullish in this economy. And so you need to relay that to long-term investing. And in order to do that, you need a huge push from the government, the kind of push that we've seen governments such as Vietnam done, and more so in the future beyond the nominal tax cut that we saw in manufacturing.
Thanks, Trinh, and we'll come back to you on some of those questions. If I can just move to Adarsh. Adarsh, for your opening remarks, but one question perhaps is, as late as December 2019, in the interviews that you gave, you were pretty hopeful of some kind of a breakthrough when it came to the US and China. More hopeful perhaps than the popular opinion at the time. Clearly that has changed considerably today. So I was just wondering if you could just start by framing some of your analysis on where we are when it comes to the US and China before you go on to your other remarks.
Sure. Thanks. Thank you, Rudra, and thank you everyone for joining this webinar. As you said, I was optimistic on a specific part of the US-China relationship, which were the trade discussions, which was the key theme of the past couple of years. And you end up getting a phase one trade deal between the US and China. You can question the content of that deal, the sustainability of that deal, whether it would lead to a phase two, but there was a trade deal done in January before the pandemic erupted in earnest. But I completely agree with you. Since then, of course, the pandemic has changed the nature of the US-China relationship significantly. And by the way, not just US and China, I think a lot of investors that we've spoken to over the past couple of weeks are very closely following the backlash against China at a global level. So we've seen it in Europe. We saw the UK foreign minister, for instance, making comments against China. We've seen it in Australia, which arguably has a vested interest in maintaining a strong relationship with China because of their trade exposure. But they're talking about an independent inquiry into China. So it's not just the US, but globally, there seems to be an increasing backlash against China for different reasons. Some of it is related to the pandemic, some of it is related to acquisitions. There are different reasons for different countries. Now, clearly, the focus remains on the US-China relationship. And again, I think from an investor perspective as well, people are very closely watching how the relationship between the US and China develops, especially given that this is an election year in the US. And I think most people will agree, in both states of the world, a good state of the world where we get past the pandemic and we start to see some stabilization and activity in the third quarter of this year, or a bad state of the world where early easing of lockdowns starts to see second waves, would see a resumption of lockdowns, and economic activity remains weak globally for a longer period of time. In both states of the world, the relationship between US and China is likely to worsen. And the key reason, of course, in the short term is because you're facing an election year. And in this election year, whereas previously the economy might have been the key election issue, now clearly the pandemic is going to be the number one issue. And for, especially for the administration, there is a pressing need to find a scapegoat. And it seems in the short term, at least based on some of the remarks we've had from the administration, that the scapegoat would be China. Now, there's there are lots of differing views from the conversations I've had in terms of when the rhetoric from the US against China really escalates. Most people that I speak to, most of our clients that I speak to, believe that this is kind of a third quarter, fourth quarter thing. So a bit closer to the election, where the rhetoric might escalate as it becomes a keener election issue. Because the thing is, the view is if he starts, if the rhetoric escalates right now, it could hit the equity market, it could hit approval ratings, it could have an impact on the economy, and that's probably not something that they want right now. However, there's a small minority that believe that at this point, the stock market in some ways is a lost cause for the administration. The voter base in the US, your blue-collared worker in the Midwest, would care about the stock market when they had jobs. Currently, they don't have jobs. So the S&P 500 moving back about 3,000 is kind of irrelevant. So you could argue maybe there is a pressing need to find the scapegoat and escalate the scapegoat in the media and in the eyes of the voter. So this is something that we're watching very closely. I think the key question, coming back to the phase one trade deal, is does it damage the phase one trade deal? Now, if you look at the phase one trade deal, there's a very small escape clause. It's literally just one line, maximum 2 sentences, which basically says that in extreme circumstances, the commitments within the trade deal can be eased. So in particular, China's commitment to import more goods from the US can potentially be eased. But like I said, it's a very short escape clause, and it's very much open to interpretation. And certainly there's a risk, if tensions between the US and China escalate, that the phase one trade deal could be terminated, could be unwound, or aspects of it would need to be renegotiated. But again, one positive thing that we had at the start of the year, the phase one trade deal, if that goes away, then for broader markets, and particularly for us in Asia, where we're partly reliant on that trade deal, reliant on China, and reliant on the supply chain, less so India, of course, that would lead to a significant deterioration of sentiment if that did happen. The longer term issue, of course, beyond the election, is the issue of decoupling. And this is not just the sort of trade and supply chain issues that Trinh was talking about, but it's also about decoupling and technologies, having independent technology ecosystems. It's a decoupling of financial systems. I think one thing we've realized through this pandemic crisis, that Asian economies, including China, by the way, are highly reliant on dollars and dollar funding. And maybe I can talk a bit more about this in the Q&A, but clearly once we get out of this pandemic, one of the key questions for reserve managers in the region, for corporates in the region, for banks in the region, will be, can we continue to rely on the dollar in the same way as we have done over the past many decades? And clearly the obvious alternative is the renminbi, but it's not an easy alternative, because the renminbi currently makes up only about 2% of global FX reserves and 2% of global payments. So there's only a limited pace at which supply chain funding, trade financing, global FX reserves can switch away from the dollar to another currency. So don't get me wrong. I think we know historically the transition from one reserve to the reserve currency to another reserve currency takes a very long time. But I do think the longer term decoupling that we're likely to see after this pandemic between the US and China will have very important implications for international finance. And one of the things potentially could be that the importance of the dollar within the region, within Asia, diminishes somewhat. By the way, for global FX reserves, we've already seen a diminishing of the role of the US dollar. It's still the predominant reserve currency. It's about 60% of global FX reserves, according to the IMF's data. But about 3 to 4 years ago, it was closer to 65%. So central banks have already been diversifying away from the US dollar into other currencies, including the RMB. So again, I think, back to your point, we were optimistic on the trade aspect of the US-China relationship. That now is potentially at risk as US rhetoric against China escalates. And of course, there are significant long-term implications of the decoupling between the US and China that perhaps we can discuss in the Q&A. The only additional thing I'd add, the big question, I think, for Asia in the context of what Trinh was talking about, is it's quite clear that policymakers in the region have chosen to focus on interest rates, liquidity, and the bond market over currencies. So what do I mean by that? If you look at what most central banks in the region have done, they've cut interest rates as much as they can. They've kept liquidity conditions flush in the banking system. They've tried to help with the transmission mechanism so that low rates go out to the rest of the economy. That's not very easy to do. But also importantly, as governments are spending and fiscal deficits are rising, a lot of central banks are intervening in the bond market. They're doing effectively a quasi form of QE. In some countries like Indonesia, it is QE. They're buying bonds in the secondary market and said they can buy bonds in the primary market. Now, historically, when Asia tends to do that, or any emerging market tends to do that, that tends to be quite bad for the currency. The pressure, the burden of fiscal stimulus and the central bank credibility being questioned falls on the currency. And I think that's exactly what we're seeing right now. I think for the time being, central banks and governments are saying, okay, we can tolerate a weaker currency for the time being, as long as inflation is low. Let's focus on getting rates low, lending rates low, keeping liquidity flush, and supporting our governments as fiscal deficits widen to make sure that interest rates, borrowing costs for governments don't skyrocket. Now, of course, I think as long as inflation is low, that's fine. At some point in the future, if inflation does pick up, then it could create issues for the bond market. But the net result of this is obviously currencies within the region remain quite weak. And I think that's what we're observing right now. I'll stop here and pass it back to you.
Thanks, Adarsh. I'm going to move to Pranjul in a second, but I just want to ask you is, back in 2008, I'm guessing that was the time that you were just beginning your career at Barclays. We're about 12 years hence. Do you see something surprising in the way that countries and international financial institutions have come together or not in dealing with the current emergency? Is there something that can be learned from the financial crisis of 2008, or are regulators and central banks a bit too hypnotized by a crisis that actually is very different in terms of magnitude what we're seeing today?
Yeah. Well, I think the key encouraging factor is that policymakers have been much, much quicker to respond. So, if you just think about how quickly the major central banks, the Fed, the ECB, even the BOJ, with limited room to ease monetary policy, but also governments in terms of, hanging up their budget rules and their fiscal deficit rules and just going out and spending. The speed of the response has been much quicker than it was in 2008. And certainly, that has prevented the tail risk of where financial markets would have been very dislocated, and that would have spilled over to economic conditions and led to a deeper and even longer economic recession. So I think speed is probably the biggest lesson from 2008. You act first and you think later. The concern, however, is this is a pandemic, as you said. So, is monetary policy and even fiscal policy, for that matter, the right way to deal with it? Do lower borrowing costs in the short term really help, especially when the transmission mechanism from your banking system is not working? And even on the fiscal policy side, if you think about spending programs, obviously you need to directed spend on things like healthcare, but spending programs on things like infrastructure or big investment projects, there's a big lead lag between the announcement and the impact on the economy. And then when you think about things like income tax cuts and cash handouts, which a lot of countries have done, people aren't going to go out and spend that in a pandemic environment. So the multiplier associated with handouts and tax cuts and so forth tends to be quite low. So the message is, central banks and governments have responded very quickly, which is encouraging. The concern, of course, is the transmission and the multipliers associated with a lot of this, at least in the short term, can be quite low.
Adarsh, thank you. I'm going to come back to some of those questions in a bit, but if I just move to Pranjul. Pranjul, there was something that Trinh said that stood out for me. She said, domestic demand is king. In a recent report that you did for HSBC, I think, you mentioned that 45% of India's consumer demand remains strong because it's primarily essential. So I was just wondering if you could just talk a little bit about the importance of sort of demand and then your thoughts on how India is doing in the current crisis.
Yeah, great. Thank you, Rudra. Great to be on the call and welcome everybody. So, let me start a little bit with the proliferation of COVID in India. And I think there's both good news and bad news here. I think the good news is that the doubling rate of the virus has eased. On the eve of the national lockdown, it was doubling every 3 days. Now it's doubling every 10 days. But the bad news is that the number of new cases every single day still remains very high, keeping India in a precarious footing. And some sort of or some degree of lockdown is likely to continue over the next couple of weeks, if not months. And of course, this comes at a big economic cost. Now, in terms of the economic cost and what Rudra was asking, between around 20th March and 20th April, India was in a full lockdown. And we estimate that 65% of the economy was shut down, which was impacting 50% of consumption and arguably all of investment. And the overall cost of this was about 5.5% of of the full year's GDP getting lost, for every 1 month of such lockdown. This is very expensive. And in order to flatten this cost curve, the government, from 20th April onwards, has tried to partially open up the economy. Now, we've got a lot of information on how they want to do it. There's a very detailed press release from a couple of the ministries. And if you bring it all together, we calculate that even in this partial lockdown, about 50% of the economy will continue to be closed. And that in itself is very expensive. We think every 1 month of remaining being 50% closed costs 4% of the full year's GDP, which is very high. So, you could be in a full lockdown or a partial lockdown. Full lockdown is very costly, but partial lockdown is also pretty costly for the economy. Now, a lot of people have been asking me recently, how would recovery look like? As in, if we do start opening up a little bit, how could things pan out? And the truth is, in the short run, it could look pretty good. Activity could start very quickly, and there would be three forces helping that out. One, postponed consumption demand. I wanted to buy water paints, but the shop was closed. Now that it's open, I'm going to go buy water paints. Second, inventory restocking. The guy who sells the paints hasn't stocked up on his inventories for the last many months. He wants to take any opportunity to stock back up. And third is just the natural buoyancy that we see in India. A country of 1.3 billion people, almost a captive audience for services, buying and selling, two with each other. That in itself just causes some natural growth. Of course, low oil prices will also help here, as Rudro, started off when in the beginning of this webinar. Overall, all of these good things, we think the second half of the current fiscal year will be better than the first half. But that's probably where the good news ends. Because once this wave of demand coming from postponed consumption dries up, then where will the second wave of demand come from? And that's going to be the big question. And I think that's when some of India's key vulnerabilities will start showing up. And then I want to discuss two of them here. One is a very overwhelmed financial system, and the second is displacement of labor. Now, we know even before the virus hit, all through 2019, growth in India was slowing because banks were very risk averse. Shadow banks had huge balance sheet problems, and nobody was lending. If you don't lend, you don't have money, and if you don't have money, you can't grow. Uh, uh, One of the big reasons why banks were overwhelmed was because they were sitting on a huge stock of non-performing loans. Now, as the lockdown continues, it's likely that NPAs at banks will rise even further, making them even more risk averse. And if banks don't lend in the future, then I think the medium-term growth potential is at risk. The second is the displacement of labor. I think a lot of people must be following here that labor, a lot of labor has left urban India, gone back to their rural homes, or is waiting to leave urban India to go back to rural homes. So restarting activity may not just be a simple button to put on. It may take a long time for things to come back again. Also remember that 85% of India's labor works in the informal sector. Many of them work in very low cash surplus enterprises. With the lockdown, a lot of them would have been wiped back. So the rural labor may not have anything to return back to in urban India. To cut a very long story short, I think the medium-term impact of the virus is going to linger on for longer, which obviously brings me to the next point, which is, so what's the government or the authorities doing about it? And here I think India stands out a little bit compared to many of its peers. I think rather than having a very large, big bang fiscal stimulus, the strategy that India has employed has been like some stimulus which just trickles in from time to time. Even the central bank, rather than using unconventional easing, has been focused more on conventional. And I think there are some good reasons for this. For the fiscal being a little conservative, I think one must remember that India's starting point was pretty precarious. The government debt was already high, the deficit was already fairly wide. Increasing the deficit will not be easy because you need somebody to fund it. And the domestic bond market is quite tired. I'm not sure it wants to absorb much more paper at this point. And of course, there's also the fear of, credit rating downgrades. So for all of these reasons, I think the Indian authorities have gone slow. And even going ahead, I think they'll have to ruthlessly prioritize, only focus on very urgent things like healthcare costs, some direct cash transfers to the very poor, some partial guarantee loan scheme for small businesses, but I don't think it'll have space to do something much bigger than that. So this brings me to the fact that, look, it's very costly to be locked down for so long, and the government can't do very much about it, and the pain could seep into the medium term. And finally, wanted to end with some thoughts on, after the pandemic, what happens to life then, and are there any opportunities for India? The one which Trin mentioned was about manufacturing supply chains. Some believe that COVID will unleash a wave of home buyers. Many countries will want to be more self-reliant, produce at home. And this could shorten global supply chains. It could lower trade flows. We've seen it happening since the global financial crisis. It may just pick up pace. And yet new opportunities could arise for countries like India, who were not a part of the global supply chains initially, but can now be a part of it if some of the buyers are looking for new sellers or are trying to diversify. So this is an opportunity, but I don't think you can seize it very easily. I think you have to work very hard to seize it. And I think what India has to do is to improve its ease of doing business, work on its hard infrastructure, like roads and ports, on soft infrastructure, which basically means bring down the regulatory cholesterol in doing business in India. It also needs to have more policy certainty, more tax certainty, and so on. So there might be some opportunities, but they won't come on its own. India will have to work hard for it. The second is digital services. And here I'm a little more positive. I think there's a huge opportunity out there for Indian IT companies. As working from home is becoming more acceptable, more investment will be made in digital transformation, cybersecurity, cloud migration. And Indian IT companies have proven to be quite adaptive in the past. And I do think they also stand a good chance of seizing the opportunity. So I do think that, not very hopeful about manufacturing without reforms, but a tad more hopeful about digital services, to continue to grow in the economy. For foreign capital, I think if global trade shrinks, and things like capital controls come back into vogue, foreign capital may shrink as well, and capital will need far more return to agree to take risks, especially in emerging markets. And here, those emerging markets which can deliver high growth will get the capital, and others will not. So it all comes back down to administrative capability of the Indian government and the appetite to do reforms over the next couple of years. What kind of reforms? That would need its own webcast. It's a huge topic. But one thought that I think India needs to have a well-articulated, comprehensive, and consistent economic strategy. I think at this point, India lacks that. For example, how does India want to engage with the rest of the world? On the one hand, it's increasing FDI limits, but on the other hand, it's also slapping all kinds of import tariffs on many goods. So it gives a very confusing signal to all kinds of manufacturers. So I think India needs to get a lot of its homework done.
Thanks, Pranjul. I'm going to come back to that because what's interesting, I think, is in the last part of what you just said is the list of issues that you point out when it comes to India is a list that could go back to 10 years or even 15 years in terms of getting the Indian economy in order. So the one question that perhaps I could leave to you, and I'll come back to you in a bit, is where did you see the Indian economy on the 1st of January, or rather the 8th of January, 2020? And where do you see the Indian economy today? So what has fundamentally changed? Is it simply that fault lines have been deepened on all the areas that you've listed out for us? Or are we beginning to see new trends and challenges that India will need to pivot to? So perhaps you could just think about that question, but I'm just going to turn to Trin for a second. Trin, one of the questions that have just come in is on looking at international institutions and their efficacy. So national governments have pivoted quite fast, as others said, in terms of response compared to crises in the past. The US, UK, and the EU have gone well beyond the 2008 playbook. But we don't hear much about the BRICS Bank. We don't hear much about, the IMF has, it's a stable source of data, and it's a stable source in terms of a steering hand. But there is a basic understanding that there is a weak response internationally or regionally. Would you agree with that assumption?
Absolutely. I think for example, I think you have swaps by the Fed, right? In Asia, we only have access with the Fed BOK, MAS, or BNZ. and I guess RBA, and then everybody else needs to do repos, which requires collateral. But you do have some regional existing swap lines. But I think during the crisis, you had more, for example, the Chiang Mai Initiative, etc. So there was a bit more of a regional effort. This time around, I think, first of all, it was very fast moving. So everyone is basically scrambling. Those who didn't get hit by the first wave gets hit by the second wave. And then you also have the issue of, as you can already see, that cooperation is not the word in town, right? Fend for yourself is the modus operandum. And I think afterwards, when it has hit pandemic, and now that we realize that the way we recover from this will require cooperation, there will be more movement. But regionally, also, you have to realize that the ability to maneuver differ very vastly. A good example is you juxtapose India and even with Indonesia. The IDR has been hit by much more, part of it because of its external reliance. If you look at the bond market, after the sell-off, it still has 32% dependency on foreign ownership, equities around 39%. And even though its credit market is shallow, what that means is not very indebted, its exposure to foreigners is quite large. So that in itself limits its ability to move very sharply to help, right? So there has been some efforts, as Adarsh mentioned, that I think there's been efforts to help via cutting rates, although not significantly. And of course, BI wanting to do QE, it wants to now move into the primary market too. But the reality is that the funding for the economies, for all these economies, the short-term shocks reflect the fundamentals. And I think hopefully there will be cooperation and also the impetus to move towards more reforms in these economies. And of course, with the IMF, there's stigma if you want to get help there as well, because a lot of the Asian economies have built up these buffers after the Asian financial crisis so that they don't need to go there, right? The IMF in itself, of course, is a great institution, and then there are many issues in which it wants to be recapitalized, etc. But for the Asian economies, we tend not to be like Argentina. A good example is the Philippines. When Marcos left the Philippines with massive foreign external debt, did it default? It didn't default. Today, it still pays those debt. I think it should have defaulted, but it's a very Asian way to have a bit of sovereign pride. And I think that in itself also limits it from asking for help. It is asking for help in a different way. For example, RBI wants the swap line with the Fed is an example. So I think there's some institutions where I think Asian.
Okay, thanks, Trinh. If I just move to Adarsh on, swaps is what you do on an everyday basis. The United States, it could be said, has been generous in opening swap lines to many of its allies and friends. Indonesia and India has been knocking on the United States' door for a very long time. For a variety of reasons, it hasn't got it. So I was wondering if you could just walk us through the logic of that. And also, and here's a question from Jayesh Nair, is clearly there's a relationship between exchange rates and currency printing. Everyone's currency printing, it will have some effect on currency exchange in itself. What does that effect look like?
Sure. So on the swap lines, I mean, without getting too technical about it, the way the Fed swap lines work is they provide dollars to, say, the European Central Bank or the Bank of Japan, who then conduct what's called operations, dollar supplying operations on a 7-day basis for 7 days and for 3 months, where basically they provide dollars, take the local currency, and basically that's swapped back after 7 days or 3 months, depending on what the tenor is. So without getting too technical about it, I mean, it's basically, as you say, the Fed providing or helping other central banks around the world to provide dollars to their local banks, to their local banking system. However, as you said, and so it was quite interesting you said that, the Fed is providing it to its allies and its friends. I don't think it's just allies and friends, but it's also about the Fed, thinking about credit risk and FX risk. To some extent, obviously, with the big major central banks like the Bank of Japan and the European Central Bank and a couple of others, they provided unlimited swap lines where they will provide dollars to whatever amount necessary. Then to a smaller, then, when they announced that, there was criticism that, there are lots of other central banks they used to have swap lines with, like Korea and Singapore. How about some of that? So they did that, but it was capped amount. So for instance, for Korea, it's a swap line, but it's capped to the amount of $60 billion US. And then you're left with, a lot of other countries, as you say, that would like swap lines. But my sense is, the Federal Reserve and the US more generally wants to help the rest of the world, but there's a limit to which the US central bank will take on that credit and FX risk. And which is why I think it's pretty unlikely that we're going to get more swap lines being provided by the Fed. There was this repo facility that Trinh referred to, which was one of the rationales for that was, we don't have the swap line, maybe we have a repo facility where you give us treasuries, US treasuries from your FX reserves, and we'll give you dollars. But no one's using that because the cost to use that is quite high. So literally, you can see the usage of this facility on a weekly basis. Indonesia has talked about it, Malaysia has talked about it, but no one's actually used it. So, one comment just to add on the IMF, a lot of, emerging market central banks, not necessarily in Asia because there's a stigma attached to it, but to some extent, Indonesia, you could argue, have, asked the IMF to be involved more, to do more. And the IMF is doing its best, of course, but they're limited by their financial resources. And one of the things that came up during the IMF World Bank meetings a couple of weeks ago, or one of the calls, was to expand the resources of the IMF by doing what's called a big SDR allocation. Without again getting into the details of this would be effectively tantamount or equivalent to IMF QE, the resources or the commitments of the various IMF member countries increasing potentially to a large amount. And that would increase the financial resources of the IMF and enable them to help out countries that are facing short-term liquidity constraints. Turns out it didn't happen because, again, the US has a veto power in the IMF, and it seems based on reports that the US was not open to the idea of an increase in SDR allocation. So, again, I think the general message from here is the US is willing to help out, whether it's via the IMF or via the Fed, but there's always a limit to which they'll help out, and understandably so, because there's only so much you're going to lend to a country that you believe might not be solvent. On the second question, it's a very interesting question. Everyone's printing money, everyone's doing QE. What sort of pressure would that impose on currencies? Now, normally, if it was just one country doing QE and running big fiscal deficits, their currency would be under pressure, as I was arguing earlier. But in some way, there's safety in numbers. Everyone's doing it, and therefore you can afford to do it and just hope that people ignore you and your currency doesn't come under pressure. So there are a few distinctions I'd make. First, obviously, a distinction between developed markets and emerging markets. I think, developed markets, either you're Europe or Japan, and you run a current account surplus, and you have a large positive net foreign asset position, which means your foreign assets are greater than your foreign liabilities, in which case we've seen when they did QE, there wasn't undue pressure on their currencies over the past 10 years. The US, of course, runs a current account deficit, but it's the global reserve currency. So it can kind of do whatever it wants, and there's not going to be any pressure on their currency. But obviously, emerging markets face a different kind of pressure. And I think for emerging markets, it's very important to look at starting points. So what I mean by starting points is what I just mentioned. Does the country run a current account deficit or surplus? Most emerging markets run current account deficits. But in Asia, obviously, we have a lot of countries that aren't really emerging markets, countries like Korea and Taiwan that run big current account surpluses. Net foreign assets to liabilities. If your foreign liabilities are greater than your foreign assets, your currency is going to be under more pressure. FX reserves, as Trinh said, Asia doesn't need to approach the IMF because most countries have built up FX reserves to a decent amount. And even India, where FX reserves were kind of not as adequate a few years ago, now FX reserves are at a much better level. The one exception would maybe be Indonesia, where FX reserves are there and they're significant, but maybe relative to external funding needs and short-term funding needs, they're a bit less than the rest of Asia. So again, I think thinking about which currencies will be under more pressure in a world where everyone is printing money, both via the fiscal deficits, as well as cutting rates, injecting liquidity, and buying bonds in some cases. I think ultimately the starting point matters. And I think Asia as a whole is better placed than some other regions like Latin America and emerging Europe. But of course, within Asia, you could have pockets where if we see further dislocation, currencies could remain under pressure.
Thanks, Adarsh. Pranjul, if I could just turn to you, we've got a bunch of questions and I'm going to cluster them together. These are questions from Lakshmi Pandey, Krishna Piduru, and Ankush Bansal. So I'm going to cluster them in two parts. One is, and it's perhaps a bit of an unfair question to you, you're a macroeconomist, but what happens to microfinance in India with this crisis? And do you have any comments on financial inclusion? I think it was quite important when you mentioned that the stimulus package on the part of the Indian government seems to be following its own logic, which is trickled down. We haven't seen the massive stimulus, even if you take purchasing power and correct for it, compared to other parts of the world. So how do you see microfinance and how do you see recovery in this area down the line? Two is the government doing enough by way of protecting against NPAs, in your view?
Yeah, great. So look, good questions. And, as I mentioned that 85% of India's labor force is informal. Most of them are daily cash earners. They work in enterprises which does not have too much cash surplus to withstand a lockdown. We always knew these things about India's labor force. But now, our worst sort of nightmares have come true. We're in a situation where, these guys have been rendered jobless, homeless, and many of them are just wanting to go back home to rural areas. And at this point, I think what the government announced already in terms of a package for them was sort of like, the first installment. I think over time, far more money will be needed. We knew these people don't have too much of a social security, a net. And I think this is going to be a tricky time, and it's going to test India's maybe social contracts. Like, can you rely on your relatives and so on when you go back home to your rural areas? I think same issues with microfinance. I think there is a lot of problem. Microfinance depends a lot on banking correspondents who perhaps walk to your house every single day, allow you to take out some money, give you some small loans. But with the lockdown, all of that has come under a lot of stress. So the entire microfinance channel has got clogged at this point. So this is a pretty bad combination, right? You lose your job, you go back home, and you can't even take those small loans that would see you, go through day by day. So it's a bad time in that sense. In terms of government doing enough for that, well, look, government has announced a little bit, as I mentioned. Of course, anybody can ask for it to announce much more. But the problem the government faces is a very macro problem. Who's going to buy its bonds? If it runs a very high fiscal deficit, who's going to buy those bonds? The domestic bond market is already very stressed out. And that is the problem. That's the main problem India is facing right now, that the starting point was very, very vulnerable. India already until last year had very high fiscal deficit, very high government debt. And now it has no space to run counter-cyclical fiscal policy. So I think what we'll have to see is, some sort of slowdown, which prolongs over into the medium term. In terms of government doing enough for NPAs, I think the question is why isn't the government doing enough to help small businesses? And I think there are some plans on the works. What we hear from media reports and so on is that the government is finalizing a partial loan guarantee for small businesses, in which small businesses will be able to get more access to working capital so they can start off once the lockdown is eased. So I think the government, something is in progress there. Let's see what the government comes out with. But I'm worried it may not be too much because the government doesn't have the fiscal space.
Okay, Pranjul, I'm just going to come back to you for a second. Pratik Datta has a question which is important in terms of transparency of the way in which decisions are made. There was a time the Monetary Policy Committee in the RBI was quite powerful. Today, it seems to be, according to him, bypassed on a range of issues, including on reverse repo. Do you see this as a structural issue, or is this an issue that we should focus on now? Or is this a larger question of administration and transparency that can be kept for later on?
Yeah, I think I'll park it for now. The truth is that these are not normal times, and a lot of decisions have to be taken very quickly. Technically, the MPC only votes on the repo rate, and it was a gray area on the reverse repo, and the RBI was in a hurry and went ahead and made a decision very quickly on it without having another MPC meeting. But that's not what's keeping me awake right now.
Yeah. Thanks a lot, Pranjul. Trinh, if I can just turn back to you. We've got a couple of questions from Andrea Tiosa and Tom Nathan. And I think at some level, these are 100,000-foot view questions, which is, what does the future of China look like after this crisis or as this crisis progresses? Are we in a year from now going to see China minus 20% of its kind of prestige and real power? Or are we genuinely going to see the diversification that everybody's talking about and that the panelists here have talked about, keeping in mind that diversification is expensive, as you yourself mentioned? Vietnam only has limited absorptive capability. In India, as one of our questioners makes clear, labor is becoming more and more expensive. There are regulatory hurdles. So what's it going to look like in about a year from now? And these are, of course, genuinely unfair questions. We're asking you to just get on a horoscope. But how do you see China in the way in which it following the pandemic?
Well, first of all, it's very difficult to forecast short term, but let's just talk about some of the key points that he mentioned, which basically is about foreign direct investment. And also, if you then relay that, what does that mean in terms of employment and growth prospect? We know, so let's talk about what we know about FDI in China. We know that roughly about 40-something% of China exports are foreign invested. They're owned by foreigners. So that could be, South Koreans, Japanese, Americans, etc., with factories. So that means that only 60% of it is owned by Chinese. But that actually has declined significantly. So was much higher. And that corresponds to actually what has happened to FDI into China. The FDI into manufacturing peaked in 2011 and by now contracted. And it contracted mostly for labor intensive. Other miscellaneous, which are basically a bit more high tech, hasn't contracted, actually rose a little bit, but as an aggregate, it has contracted. And if you look at the FDI data that was published recently year to date, it has fallen. So that means sticky capital flows. Portfolio flows have declined and then normalized, but in terms of sticky long-term, building a factory, that sort of thing, other than Tesla, everything's down. And the reason why Tesla is in China is not to arbitrage China's labor costs or China's supply chain, but is really to sell to Chinese consumers who are the rising middle class with more income. So the story for inflows into China is perhaps arbitrage at a higher level. So it's no longer about China being cheap. It can be relatively cheap for some level, but it's no longer the cheap story. It's about a massive market, unparalleled, right? So everybody wants access to that. So there is still inflows, but inflows take different in nature. But as an aggregate, FDI inflows are down. Now you say, okay, so diversification is great to say, but it's expensive, but actually has happened already. We know that in Asia, a good example most recently is Taiwan reshoring policy. Taiwan is an outlier in PMIs in Asia. It's actually got a PMI above 50. It's got an export order that's a +4-something%. And that's outshining even South Korea, even if you take into this account that things like Zoom and work from home and all these things use more semiconductor. But Taiwan is still outperforming because Korea's chips are down. So that reshoring policy is big. And if you look at South Korea FDI, it has since 2014 has moved much more capital into Southeast Asia than it did to China. So that level is bigger, and Southeast Asia is much smaller than China. So that means that more of this, and the story of Samsung Electronics in Vietnam is a case in point. Now, South Korea also has moved to Europe. So people talk a lot about diversification, not just in terms of Asia, but Asia isn't the only recipient of flows. South Korea has done a lot of FDI into the US itself, right? So when you talk about diversification, reshoring, decoupling, and all these tariffs, it just basically, the barrier to trade means that you want to be close to your customer. So you could be going to Mexico, for example. So that Northeast Asia coupling with Southeast Asia and decoupling from China has happened, but it's happened specifically in the trade arbitrage to export from China story. Of course, there's more flows to China to serve China. So what does it look like a year from now in terms of capital flows? I think that itself will accelerate. No doubt about it. You already see the data. Q1, you already know it's going to be accelerate, Q2, Q3, Q4, and people are going to try to come up with some grand strategy, and things happen very gradually and then suddenly, right? And then that's the gradual process has already occurred in Asia since 2014 for many reasons. We know wages have risen, we know regulatory have risen, and we know that China doesn't need it anymore. So it hasn't not that it doesn't need, but it's not an emphasis, right? So if you look at its 5-year plan, the emphasis is more higher end of tech, China May 25. So what that means is that if you look very simply on China's balance of payment, trade itself, right? Exports were down in Q1 by double digits, although March normalized a bit, and imports weren't down so much. But then you look at FDI, so the capital flows weren't there. So the ability to accumulate reserves is not going to be as easy as before. So reserves have actually gone down a bit. So I think it's not going to be an easy to grow story. It's not going to be an easy to grow story from an external demand perspective, not just because of the collapse of income happening globally because of shutdowns, but also because of barriers through trade, like we know from the US-China trade war, but barriers through investment, right? You know that during these times, many countries worried that the decline, our Aussie dollar, the decline of Aussie dollar, the decline of Aussie assets means that there's going to be hostile takeover, etc. So many of these countries are either paranoid or rightly worried, where we can't judge, but the point is that that has consequence in terms of globalization as we know it. There's going to be barriers on top of existing barriers to trade and investment. And that in itself is going to be a friction for China's ability to grow its global market share, which is roughly about 12 to 14%. And it probably peaked around 2016, 2015. And it's still quite elevated. We know that 1 out of 5 items out of China in the world in manufacturing comes from China. But I think that means that the picture in terms of growth is going to slow, right? We know that already this year, and we know that from trends. And I think that's something that people will accept as the new normal, and there are opportunities there, but the friction to it is going to be not just in terms of its own debt and demographic, the double Ds, but also this D that I talk about, deglobalization and decoupling trends.
Thanks, Trin. And Adarsh, if I can just pivot to you, I've got 2 questions, and I'm just going to club them together. The first question is from Ryan Vallis, who curiously identifies himself as a wannabe unicorn. And the question he asks is, and you're a Forex person, is, if you were a betting person, where would you invest today when it comes to currency stocks, for instance? So, what in your mind if there are any safe harbors at the moment in terms of investments, where would they be? So that's a very transactional question. But a larger question is, Trinh talked quite a lot about deglobalization, that everybody seems to be looking out for themselves. Manufacturing is coming home, also the rhetoric would suggest. Countries have already mandated that certain parts of the manufacturing goes back to companies that are investing in the manufacturing unit. Do you agree with this basic trend? Is deglobalization the way to go? And here I'll just pivot to a completely separate set of issues. When it comes to global conflict and peace, for instance, today the UN Secretary General announced what he called a global ceasefire, which is quite amazing, actually, and which just basically means every battlefield in the world, from Yemen to Palestine, stop fighting with each other. And the hope is very much the UNSC supports this with some kind of a resolution. Some might call me a hopeless optimist and an internationalist. What we're seeing in the world of economics is quite the opposite. China and the US are just not being able to come together, even in the time of pandemic. They did in 2008. They did with SARS in 2002, but they're not at the moment. But having said that, do you buy the argument about deglobalization, given how financially integrated the world is?
Sure. So on your first question, I mean, a safe haven in these turbulent times, as most people would agree, gold for most people looks pretty attractive under most scenarios. Either you have a scenario where we come out of this very quickly, there's a massive release of pent-up demand, the dollar weakens, inflation goes up, and gold prices continue heading higher. Or we have persistently weak growth, a permanent shock to global demand, real interest rates across major economies stays negative, which means gold, which is effectively a zero interest rate, actually looks pretty attractive, and gold moves higher. So it's a pretty consensus view that gold should do well under most scenarios. We have our commodities team has a pretty aggressive forecast, so they think at some point next year gold could go as high as 3,000. So we're below 2,000 right now. So the spot price could go as high as 3,000, which is a pretty aggressive forecast. Whether it goes as high as that, I don't know. But yes, I would agree with the underlying rationale that gold under the current state of the world looks quite attractive. In terms of currencies, of course, it's very hard to define safe havens during these turbulent times. I mean, most countries are being hit by the pandemic. Most countries are vulnerable to what we discussed about large fiscal deficits and quantitative easing. But generally, I'd say like within Asia, the Japanese yen typically looks quite attractive under these scenarios, because even though it's doing QE and has large fiscal deficits, it's been doing that for 20 years, and it's been fine. And it's been fine because, as I said, Japan's been running a current account surplus for quite some time, and they have among the largest positive net international investment positions in the world. So the Japanese yen, in our view, should do quite well from a purely currency perspective. Now, on the broader question of deglobalization, I mean, I think during the US-China trade war in 2018 and 19, it became quite apparent that companies and corporates were thinking ahead in that, even if you did get a trade agreement, it was very difficult for a company to go through that level of uncertainty again, which is why we had sort of very incipient, very early trends of companies thinking about or planning to shift production away, from China, either to other countries, but also back to their own countries. This is true for US companies. We saw some limited evidence of this. Our equities team, our sector analysts have asked a lot of the companies, we have surveyed a lot of our sector analysts asking whether companies that they cover, be it in technology and consumer, in healthcare, what's going on in terms of the shift in supply chains, are companies shifting or not? And it was very interesting that the majority of them said that companies are have either shifted production away from whatever country it was in, mostly in China, but of course other countries as well. And a lot of it is going to Southeast Asia, which seems to be a beneficiary, as we discussed. But a lot of it is going back onshore as well, despite the higher cost of producing onshore. So I think deglobalization was something or a trend that was in place before the pandemic. The pandemic, because it will lead to very significant geopolitical spillovers, probably means that trend of deglobalization continues. And of course, it's not ideal from an efficiency perspective. It's not ideal from a cost perspective, and it will take time because supply chains tend to be quite sticky. But I think the pandemic, in some ways, will have taught people about the risks of running supply chains that are very, very sensitive to small shocks, and obviously very sensitive when you have such a large shock as a pandemic. So from a risk management perspective as well, I think the move by companies will be at least partly to shift production lines or concentrate production lines into fewer countries, not necessarily just one country, but into fewer countries where it can be better managed in the event of a big risk event or a risk shock.
So Adarsh, I'm going to come back to Trinh and Adarsh for their concluding remarks. And the question I'm going to pose to you is, what is the one genuine opportunity that you think is possible in this time? Where's the silver lining, for instance, or is there a silver lining, or is it simply relative from your vantage points? And the question is specifically on India. So it'll be interesting to get your views from outside of India onto this country in itself. Trinh has mentioned some of this, but it'll be interesting to get one crisp answer, one silver lining for India. But before that, if I could just bring Pranjul in. Pranjul, Arvind Dose has a question from Harman. And you in one of your papers for HSBC has said is that the silver lining for India could be a return to the rural sector when it comes to manufacturing. So you see a kind of a refocus on a different form of urbanization. Is that a general opportunity to accelerate growth in India? And is that going to have a systematic effect on the medium to long term? And any other comments that you have as far as concluding remarks go?
Yeah, sure. So it ties in well with, silver linings. What we've seen in India is that it reforms best during crisis. The last time we reformed a lot was during the 1991 balance of payment crisis. So can similar opportunities come up this time? And I can think of three. One is, your question that you put to me on rural industrialization. Unfortunately, for the last several decades, rural India has been hobbling on one leg, just agriculture. Now, the way we're opening up, we're actually allowing a lot of activity to restart in rural India, but continue to remain in lockdown in urban India, because it's in urban India that there's been much of the COVID proliferation. This opens up a window of opportunity for rural India to actually ramp up on some industrial activity. For example, a little more sophisticated processing of food items and so on and so forth. The other advantage rural India has right now is that a lot of labor has moved back. So overall, hopefully this, silver lining here could be that something in some industrial activity really picks up in rural areas and gives rural Indians, two legs to hop on, not just agriculture. The second reform, I think, is agriculture marketing. Rural Indians and agricultural farmers, they only sell to the government wholesalers, which is very inefficient. For the first time, when we are seeing a lot of the government big markets, mandis, being in a semi-lockdown situation, for the first time, we are seeing farmers selling directly to private sector procurers. And this could be a beginning of a huge agricultural marketing reform. And the third reform, which I think can come up from this COVID crisis, is fiscal cleanup. We've realized we're not being able to give a big fiscal stimulus because we don't have, we can't borrow too much. So can we reprioritize? There's a lot of subscale expenditure we do. Can we get rid of some of these old schemes and use some of this money as direct cash transfers? So some fiscal cleanup can be a big reform for the medium term. So these are some of the reforms I think can come up, even though things are really, really bad at this point.
Again, if I just ask you very quickly, Pranjul, you're somebody who's been covered in the news and featured as somebody who takes contrarian positions in times of crises. What's your contrarian position today? Where are you going against the grain?
Yeah, so well, I think it's about the medium term outlook. I think it's been damaged a little bit. Our financial sector going through another round of NPAs. It won't be very pretty, and it won't be very easy for them to come out of it very quickly. Our indebtedness situation is also something to worry about. The government has too much debt. Corporate debt was also fairly high compared to what Indians can generally deal with. So I think at this point, our medium-term growth is may not be very high, and I'm sort of I don't see why people think we'll have a V-shaped recovery.
Thanks, Pranjul. That's very helpful. Trinh, very quickly on India.
Well, I think it's an opportunity. I very much agree with Pranjul, and I think the hard part for India to do really is on labor and land reform. And I think a good example is that if you have a firm that has greater than 100 employees in India, to dismiss them, you need government approval, right? And then that's one of the key reasons why informal employment is so massive in India, because there is an incentive to keep those people informal. And for India, and very much has to do with the fact that I think there is a huge political will to do it. You saw Made in India. It didn't really make that push. And then recently with the tax cuts, but I think that in itself, this time around, needs to move and look outward. It's a massive economy. It's called subcontinental in size. And although, it speaks English and people are quite global in their internet connection, I think the economy itself is very, very domestic in nature. When you do sensitivity analysis for India, that's just a strength, because India is not external, linked by tourism, trade, and of course there are certain sectors in which is very, but on an aggregate, not so much. So as such a massive economy, I think it has a lot to contribute to the world, and that means that it needs to move a few things around and push forward. And I think that can be done in this shared movement in India, where everyone's under lockdown, and hopefully it comes out of it more together than fractious, and to create this momentum. And the second thing I would say is that investors tend to cheer India on despite being disappointed. And they continue to value Indian assets. As you can see, valuation still is among the highest in the region. And look at portfolios, etc., and particularly FDI, because I do see a lot of corporates in the region, and I think generally people do look for it. And as you can see, Mark Zuckerberg, one of the deals he's done during the pandemic is on India. But he isn't alone. Everyone is looking for opportunities. The question is India looking for that opportunity? Is the Indian government doing enough? And I give you an example of what the Southeast Asian did in order to get FDI. Thailand, when it wanted manufacturing, the head of government went to Japan and asked the corporates of Japan, what do they need? And they came home and they gave them what they want. They couldn't give them on a systematic basis, but they gave those big brands, because what you need is give just one big brand. A good example is Vietnam. In 2010, Intel invested more than $1 billion in Vietnam to build this massive factory. That is a huge moment for Vietnam, because who would invest a massive factory in Vietnam at that time, right? It was a huge problem, the labor, all kinds of issues, and they sorted it out. But what happened was that after Intel, you have Samsung Electronics, and Samsung, the same thing. The Vietnamese government asked Samsung, what do you need? We'll give it to you. They freed the land in Hanoi airport. There's even almost a terminal for Samsung itself. Samsung recently, because of the quarantines and the lockdown in Vietnam, they couldn't get the engineers. They had the exemptions to go through this, right? So their needs, and what happens when you have Samsung? You get all the other Korean electronics, because that is the branding, right? If you have the biggest guy in town coming in, you're gonna get Lotte, you're gonna get LG. The Lotte is the consumer side, but LG and all the other ones. And increasingly, you get the suppliers, the smaller South Koreans, the Taiwanese, the Japanese, the Americans, the Chinese. So I think for India, it needs to realize that not only is the world looking for India, India needs to also look for the world. And that in itself has to be very targeted and then aggressive and then eventually broad-based. If it cannot do a massive reform, big bang, perhaps it can start in a targeted way to brand itself.
Trinh, that's incredibly helpful. Thank you so much. Adarsh Sinha, your concluding thoughts and any reflections on India?
Yeah, so I'll keep it to India. I'll keep it to, shorter term silver linings for India. I think the most obvious short-term silver lining for India is the collapse in oil prices. So we estimate that basically India will not have a current account deficit in this fiscal year, so it'll be 0% of GDP. And in the following fiscal year, the current account deficit will be pretty small, about 1% of GDP. So, in these times where balance of payments is kind of everything, to have that benefit of oil prices going down a lot is going to be huge from a current account perspective for India. And hopefully should ease some of the burden on the currency. Although keep in mind, as you said, oil prices have gone negative, they've collapsed, but there's about a 1 to 2 month lag between spot oil prices and its impact on India's overall current account deficit. So that's one silver lining. The second silver lining, I think, in the context of deficits and debt, we've had a few conversations with rating agencies, and so far there's no sign that rating agencies are thinking about or looking to downgrade India's rating. So the idea is that basically the higher growth track record and India's sort of structural growth level is one of the main things that supports India's current rating, and it's sort of, rating agencies probably want to see what happens coming out of this pandemic and what happens to India's structural growth rate, which, as Pranjul said, we might be pessimistic on in the longer term, but at least rating agencies are willing to wait and watch, which, by the way, is not the case for a lot of other emerging markets around the world, where they've gone on and downgraded or put on negative watch. So again, I think from the bond market perspective, that's encouraging. And also related to that, I think it's encouraging that the past year the government has taken small steps towards opening up the government bond market to foreign investors. India has relatively lower foreign ownership in its government debt market, but obviously if deficits are large, then I think over time the government will need to rely a bit more on foreign investors. And this goes back to Trin's point. I mean, if foreign investors do have access to the bond market, there will be buyers because the yield is attractive, and as long as you believe in the structural growth story, then you will have an incentive to buy bonds and help finance the government deficit. So that I'd say is another silver lining from a debt and deficit perspective.
Others, thanks. Just very quickly, you speak to people from Japan, Taiwan, Asia all the time. Trinh made a really important point that there is a demand outside there. India has to capitalize on that demand. Do you agree? Does that demand still exist? That basic fervor to invest in India, does that story still hold strong at this time?
It has for many years through thick and thin, where, as Trinh was suggesting, FDI portfolio flows have been FDI inflows have been the one stable component of the capital account or capital inflows to fund the current account deficit. So I think history tells us that the appetite to invest in India is still there. Looking ahead, I think the only question is, what sector in India? And I think earlier we were discussing that India perhaps has a competitive edge in technology and in technology-related services, and maybe sort of more of the FDI could be directed there. But again, I think, yes, India is an attractive destination for foreign direct investment. That's what history has told us. And the only thing to think about in the future is, what sectors should India be targeting for more foreign direct investment?
Trinh, Pranjul, Adarsh, thank you so very much for joining us on a Carnegie India webinar. For those who've tuned in from different parts of the world, thank you so very much. We had many more questions than we had time for, but we will try and figure out a way in which we can answer them for you. Till then, stay tuned and stay safe. Thank you very much.